Hey folks, Chris Versace here from Thematic Research, and welcome back from the Labor Day holiday weekend. As you probably know, August was another positive month for the markets and for our thematic suite and targeted exposure suite of models. It was a nice month as well. We'll have much more to share with you on that front tomorrow. But as we've closed the first day of trading of September, a month that is seasonally one of the weakest ones in the calendar, we have started off a big data week, one that is likely to have implications not only for current quarter GDP expectations, but also for prospects of a September rate cut as well as overall rate cut expectations held by the market. If we take a quick look at the CME Fed Watch tool, you'll notice that it implies market expectations for not one, not two, but three 25 basis point rate cuts between now and the end of the year. Here's the thing. Back in August at Jackson Hole, Fed Chair Powell said that based on incoming data, especially given the scenarios he laid out for the jobs market and for inflation, that a change in Fed policy may be called for. Keyword may, which means the Fed will be following the data, so we as investors must be following the data as well. And that brings us to what we saw in today's August manufacturing PMI reports, which, have to be honest, wasn't all that supportive of a Fed rate cut later this month. Did manufacturing activity improve in August compared to July? Yes. Did the rate of employment creation pick up? Yes, it did. But inflation either remained stubbornly high or accelerated, depending on which PMI report you read, the one from ISM or the one from S&P Global. Now, here's the thing. Before we get overly excited, let's remember that manufacturing accounts for about 10-15% of GDP. And because of that, what we see on Thursday from ADP's employment report for the month of August, as well as the August service PMI data from both ISM and S&P Global, that combination is going to be far more insightful about the economy in terms of what is its actual speed, what was the level of job creation before Friday's August employment report, and what does it say about wage inflation and inflation in the service sector of the economy ahead of the August CPI and PPI reports. Now, if we were to take a look back at S&P's flash PMI report that was released a few weeks ago, it showed a pickup in the service economy. It showed hiring accelerated, but it also showed the same for inflation pressures. So, if the data that we get on Thursday confirms this, and Friday's employment report shows a print that is back in, let's say, sequential growth mode. In other words, call it around 100,000 plus or minus 10,000. It just has to be up sequentially and stronger, if you will, compared to what we saw in July, as well as May and June. If we get that picture, the market may need to rethink its rate cut expectations, especially with more signs that companies are leaning toward or announcing price increases as they have to restock their inventories at higher input costs. Now, as we navigate these data points, we will continue to follow the signals that speak to our models, and you can see some of those latest ones down below. We'll be back tomorrow, like I said, with more on the model performance in August, and then we'll be back on Thursday to break down the day's data and share with you its implications, both for the economy, the Fed, and odds are we'll share some more signals. Thanks for watching.